Canadian oil and gas stocks have become a huge favorite among dividend growth investors, and I think there's one that stands out among the rest. Canadian Natural Resources, while it might not be the cheapest valued, it might not have the best short-term opportunity, has the most interesting long-term opportunity of just about any stock in Canada right now. There are some huge macro changes going on in this environment that are going to change the way this company is valued, that are going to change the way this company cash flows, but they're not going to change the fact that this is one of the best dividend payers out there. And all of a sudden, the runway that these guys can continue to grow that dividend got extended from 5-10 years to 25-30 years. And that change could get you millions of dollars in long-term return on cash. So we're going to talk about why this is such a great opportunity here. And it all starts with the dividend. Now I've got the screen here from fiscal.ai. I've got some dividend stats I really do want to show you. Right now, these guys pay out a 5.7% dividend. That is substantial. Usually to get anything over 4, you got to take on some additional risk. And here, the risk you're taking on is commodity risk. Of course, it's an oil and gas company. So you're thinking when the oil price goes down, they must cut dividends. Not so with these guys. One of the advantages of being such a large oil sands company, in contrast with some of the energy peers around the world, is they can sustain this dividend down to a $40, $45 WTI price, which is something even lower than the lows we've seen over the past couple of years. We'd have to be talking about a massive disruption to see oil prices that low. And because they can sustain the dividend that low, there's very little risk for them cutting this dividend out from under you, something that income investors have loved. But of course, if we're thinking dividend growth, where's the long-term growth opportunity here? Well, first and foremost, I got to point out the payout ratio is only 70% right now. And oil is hardly high flying. We're not talking about one of these boom times when you could see the dividend balloon upwards and then suddenly become unsustainable. That hasn't happened with these guys. Instead, they've kept the dividend reasonable. And when you do see those jumps like 2022, they maybe pay out a special dividend, but they keep that dividend growth story intact. And they're going to continue doing that as long as they can keep growing cash flows. And that's where the macro comes in. Because I think the macro environment these guys are in is completely changing the way investors understand the value of the stock and understand the long-term potential for this stock as far as cash flows go, which of course could create that dividend snowball opportunity to be way bigger than anyone expected. First and foremost, let's talk a little bit about valuation, because you might be wondering, okay, there's lots of oil and gas companies out there. This is the brand name. It's one of the most reasonably valued out there. Why is he talking about these guys, right? Why not Whitecap, ARC, Synovus? Man, I could name stocks all day, but why these guys? What makes C&Q special? Well, there's a couple numbers I want to show you, but the first and the most important, market cap. We're talking about a $91 billion Canadian company. And that's really, really substantial in the current environment. But the second thing I want you to look at is that enterprise value number right underneath there, which is at $109 billion. And really, I want you to think about the value of what these guys owned. Now, this is going to be easy for some of those dividend investors out there who own things like REITs, where you can really kind of picture, okay, they own these assets, which in the case of a REIT is a building, but here we're talking about oil sands, right? These giant, just like treasure troves of oil assets. And they have all this technical expertise, they have all this machinery, they have all this ability at scale to produce valuable crude and ship it. They also have obviously the natural gas business and so much more, but if you really, really refine it down to the most basic sense, they own these great assets that allows the rest of the business to work. And those assets are where the macro environment's about to have a huge boost to this company. Now, to understand the macro environment, we got to understand what's going on in the world of oil demand. And man, this is not an area that most of us retail investors like to tread in, because first and foremost, oil traders or anybody trading on the commodities markets, my hat off to you, because trying to predict movements must be so frustrating. But one group that seems to have an idea, or at least have some serious influence on where long-term price trends go, is the IEA. And they're about to drop a bombshell. It's been leaked, and again, just a leak, that this fall, over the next couple of weeks here, we are going to see these guys massively revise their forecasts for oil demand. And that instead of them predicting peak oil in the not so distant future, And by that, I mean peak oil demand. They're pushing that out to 2050. And they're saying that there could be up to another 10 million barrels a day, up maybe even 15 million barrels a day more demand than previously expected. And that means that long reserve life assets are about to become a huge amount more valuable. Now, obviously, this is a little bit of speculation, but I have it on pretty good authority that this is consensus and it is growing. When the IEA drops this report, there will be no disputing this. Doesn't matter if you're, in Calgary, in the boardrooms of the major Canadian oil companies, you're down in Houston, right? And sort of the heart of the US oil business, or you're on New York Wall Street, right? Where the investment bankers have been kind of dodgy on if they believe in the longer term potential for oil. Everybody's going to have to come around because the IEA set consensus that peak oil was coming soon before. And now they're shifting their tone. And now they're shifting the way that the industry looks at this. Now they're shifting the value proposition for things like longer term investments. And that shift alone in consensus is going to shift valuation. Now, one of the biggest things that I heard whispers about over the last little bit that we've seen sort of rumored for the last couple weeks, if not months, is that major US oil companies are here in Alberta right now. And they're kicking the tires, to use the phrase from this article back in July, but they are looking at the resource basins here. They are looking at, maybe acquiring companies. We've got all sorts coming up here from major US investors. And that's a huge turnaround from where we were just a year ago. Just a year ago, we were talking about major American companies getting out of the oil sands, literally selling them to CNQ. Selling off these Athabasca oil sands assets to Canadian Natural. And now they're back. And they're not looking at Canadian Natural sideways yet, but they are looking at a lot of those smaller players. I have heard from friends that work in the industry, from folks down in Calgary who are, in those kind of spaces, that we have seen some serious interest from big money south of the border because they are looking at the shorter term reserve life of shale oil suddenly not really aligning with the longer term incentive that this new IEA report's going to have. And they can see that there's a mismatch there. And they can see that, the twilight of US shale, the fact that they're not going to continue to grow forever, instead of being a feature, is now quite a bug, right? Instead of that actually benefiting them because they're able to maximize the price they get out of this asset, now they're like, whoa, the long-term price of oil could continue to climb, which is not something people had predicted as recent as 6 months ago. And now they're looking at long reserve life assets in one of the few investable basins out there, which is here in Canada. And who owns a treasure trove of these assets? CNQ. Now, like I said, CNQ is not what I would call an acquisition target, but I actually think that's a huge benefit if you're looking for long-term growth. If you're looking for the ability to grow, your dividend snowball here, CNQ might represent a better opportunity than something cheaper because they don't have the risk of getting that long-term growth cut away from them, but they do get the reward of seeing the assets they own valued more appropriately. Think about what's going to happen when we do see a major US firm buy out another Canadian oil sands company, right? When we see tens of billions of dollars flowing into these assets, suddenly trying to snatch up what is left here, what is available here in these low cost, long reserve life basins. What's going to happen to the rest of them, right? As there's more and more demand, the price is going to rise and you're going to see valuations on companies like CNQ expand as people realize, oh man, they own some of the best assets out there. And they can last this new longer term time horizon. And think about how that's going to impact cash flows. I've got a chart here that I think is really interesting that talks about this long reserve life production cycle, right? And if you just look at the way they continue to just slow and steady grow, and you compare that with the way that others might react to commodity prices, you can see why this stock could be a dividend investor's dream, because they're paying out a great dividend right now. Their future valuation is kind of up in the air right now, right? There are some who think they're going to go to the moon. There's some who think that they're going to be, held steadily at this valuation. They're going to see production ramp. There's some who think that, maybe all of this is overreaction. But right now, you can still get in at a cheap price. You can get that 5% dividend yield. And you now have this long-term potential for them to just continue to pump out cash flows, continue to slowly ramp their production, right? The production per share, maybe in times like this where we're looking at buybacks, but maybe their production in general, if we see a future major expansion to the Athabasca oil sands, maybe a major, acquisition of another smaller player, right? In this race to gobble up assets, who knows? But the potential is there. The long-term future is there. And if you're willing to hold, you could be looking at that few percent outperformance every year over decades that turns people from gamblers into real long-term investors. Those are my main thoughts on this. Please let me know in the comments down below. Are you kind of aligned on this? Do you see the future potential? Are there other names that you would rather own, at least over the next couple of years? Or are you in? Are you buying some of these shares? I would love to hear your thoughts in the comments down below. If you like this video, please do like it. You like what we do here on the channel, you like covering these kinds of Canadian topics, please do subscribe. And I hope I see you in the next one.